Welcome to the Common Sense Investing, or CSI Show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. I'm Victor McClure.
I'm Guy Allard. Welcome to the Star, our corporate headquarters.
That's right.
It's true.
That's right. Every time I go to that Star place, I'm trying to figure if I want to spend another $200 at lunch. Like,
Yeah,
for those of you who don't know, I'm cheap.
That's right. Anything exciting or entertaining that you want to talk about that's gone on in the market or politics or trade wars or anything this week, Vic?
Oh, my gosh. The market seems to go up 300 to 600 points or down 300 to 600 points every single day.
600 points. You just don't know which way depending on the day, right?
Or it could be up all day, and at the very end of the day, it flies down 200, 600. I'm like, whoa. There's just no way to know. Volatility.
Listening to someone the other day, they were talking about, as of Wednesday, that the yield curve is flattening. These are indicators, technical analysis, Fibonacci, all that stuff would indicate we're coming into a recession, but we've got so much positive things. It seems like, and as we talked about, it goes up 600, it goes down. You know, it's almost going to move 600 points. You just don't know which way. But there's so much good stuff, and there's some bad stuff. So, I mean, I just don't know that it understands what to do.
There's no way to know. I mean, for those of you who don't know what a flat yield curve is, it means usually the longer you go out with a bond or a CD, the more interest you get. Right now, 10-year versus 3-year are pretty close. So it means a flat yield curve. Your yield curve isn't going up as you get longer maturities.
Which means it would be silly to play the back end of the yield curve. We talked a week or two ago about playing the front end, which means keep your money short, your powder dry, so that you'll be postured.
Right. You just got to be careful. It thinks like, every time I think there's something going to happen, something else happens. So I don't know. The market just seems to be going on, the Trump tweets.
It does.
Congress stuff. So I don't know.
Or the deal. I tell you, before we get too heavy, I did hear about an interesting book. I haven't gotten it, so I can't personally endorse it, but it sounded pretty good. It was by Nicholas Taleb. Is your son a professor at NYU?
Not NYU, no, the City of New York college system.
Okay, so he's in New York. Taleb is a professor at NYU. The name of the book is Skin in the Game, and it's kind of the emotions of investing and the psychology of things, and made some really good points, I thought. One of his points was the willingness to accept one's own risks. I mean, take the risks, accept the responsibilities. You're going to feel the good, the bad, was an essential attribute to someone that would be a hero or a saint or just flourishing people. And he went on to take that example, and I thought was very good, because we always hammer the politicians. Not that we could probably do any better ourselves. Once you get up there, I'm sure you get on the merry-go-round and it's hard to get off. But the problem is they make decisions all the time, and they don't have to accept their own risk. They don't feel the immediate consequences of a mistake. Therefore, their mistakes don't teach them lessons. They don't learn a lesson because they're not feeling or accepting their own risk. Everyone else is accepting the risk for their decisions. So anyway, interesting concept, kind of enlightening. I thought it would be enjoyable.
When you get it, let me know.
Give you the capsulized summary version.
Give me the Cliff Notes.
Cliff Notes, you got it.
I remember in high school, I think I read Cliff Notes way more than I did the books or whatever.
You're a pretty fast reader, though, anyway, aren't you?
Yeah. Just wanted a shortcut back in. That's pretty much it, I think. Like I said, the market's just really volatile. I hate saying this all the time, because the last probably 3 or 4 years I've been saying I've never seen it this volatile, but every single year it seems to get more volatile.
You're going to be saying it for a while, I'm afraid.
Yeah. And I don't think there's anything, once you get valuations on the market as high as they are, then you start getting geopolitical things going on and interest rates rising. Those are a whole recipe for volatility, a lot of it. So people always ask me, what should I do and all that stuff. It just depends. It depends on how much risk you're willing to take. The one thing a lot of people don't understand when it comes to risk, when it comes to their finances, some people think they know the risk, but they always undercut the risk that they really have. Like if you told an average bond fund holder that he could lose 20-30% of your money, he'd think your principal, he'd think you're crazy.
Yeah. Or trying to sell him something or something.
Yeah, oh yeah, trying to sell me some crap. But bond funds, in search of yield, have gone really long term in their bond holdings, and they've gone to high yield or
junk
bonds to get yield because the AAA stuff didn't pay enough. In other words, I'm a bond fund manager, and I'm competing against the other 10,000 bond fund managers out there. Let's say I'm a really astute one, I'm a very conservative one, I'm only doing your AAA stuff, and I've got a yield of 2%. Well, these other bond funds are getting billions of dollars of inflows because they're making 5%. And you don't realize those 5% bond funds, that's what everybody looks for, because even if you got a 401k and you're looking at, all right, I'm going to put part of my money in stocks, part of my money in bonds. Well, this bond fund made 2, this one made 6. Which one are you going to pick? I'm picking the 6.
And they usually don't put 100% in AAA. Usually they carve out a little bit for the higher yield stuff.
Because they can't get yield on good paper now. So in search of yield for several years now, they've been getting riskier and riskier. But interest rates have continued to fall up until recently, right? And so therefore it bailed them out, kind of like your book. They never had any consequences to them buying junk bonds this whole time.
No skin in the game.
When interest rates go up, that's when they get murdered. You can lose a huge amount of a bond, even if you in a bond fund, if interest rates start going up.
And the further out the bond, the longer the term, the more you can get hurt.
The further out, the worse they can go down. The lower quality, the worse they can go down. Yeah, so if you got a lot of far out, non-investment grade bonds, which most bond funds have, by the way, you could get destroyed in those things if these interest rates start going up precipitously. There was another article today. It was actually last Thursday or Friday. Said that I think it was Thursday. Said that they think that we can raise rates faster than we thought before.
Yeah.
And still the economy will be able to withstand it and all this stuff. The economy might. Bond funds won't.
For sure.
So you got to be real careful with that. That's why you got to look for alternatives to bonds, stuff like that.
We've been talking about this volatility, and we will probably for the next several months, and I might as well be redundant again, if that's not redundant, overly redundant a lot. You have to have a plan. You have to stick to your plan, or you're going to get whipsawed in and out of the market, whether it's news on the TV about the administration, whether it's about talking about a war, whether it's talking about interest rates, whatever the case may be. The short-term investors on a lot of these instances will start driving the market because they'll get out. They'll get out in and out real quick. And when you're getting out and the market gets down to a certain point, that's when the hedge fund managers and the large players, they buy the dip. And then the market comes back up, and all these investors that got out because they were scared because of all the bad news say, oh, well, maybe there was a mistake. The market's going back up. And so they get in. And then, the big guys can take a little profit, and the cycle repeats itself. It's not made for the little guys to get in and out and trade this thing unless you're really watching it every day. And even then, only a few people are very successful at it. So if you have a plan, if you don't, you need to come up with a plan that fits your needs and just stay the plan.
Oh, yeah. I've got, I've watched people for 30 years now managing their funds. And the ones that love it are always successful in their minds.
Oh, yeah.
Always.
Or they don't tell you.
You don't realize, well, the market's made that 5 for 18 years, but I've made about 8. But if you will go deeply into it, if you really look at the portfolio, which they will not, you'll find that only 40% of the money was in that market making 8. The rest of it was in a money market making 0.1. So the overall, they made 4, when if they could have had an all market, they'd have made 5.2 or something.
Right.
So, because what they'll do is they'll segment their money into, it's a segment bias. You'll segment your money. Things that you do well, you'll bring that at the forefront. That's going to have more attention. That's what you make. The losses, you kind of ignore those kind of. Or the ones that you put money market, you're going to ignore that because that was cash reserves and I needed to have that, blah, blah, blah. But the truth is the overall portfolio made 2 or 3%. And somebody goes, well, you don't understand. I've always made at least 8% a year for 30 years. I go, was the money 6 times what you started with? No, but then you didn't.
People don't usually know what their true yield is. They don't know what their true fees are, and they don't really know how the market's performing in in perspective to how their portfolio's doing. I mean, they just don't.
No.
Because it's not what they do every day.
Right. But I'm telling you, the most astute engineers will get this wrong a lot of times because they're segmenting their gains and losses. In their own mind, it's a natural thing. I was looking at this, I was watching this thing. Can you see these light blue lines when they squiggle lines? Well, there are no white blue lines, but it's all white. But you can't tell because your brain processes that way. Brain processes that way when your investments too.
Yeah.
Is you're naturally going to pick the ones that did well. You're naturally going to give them too much credit and give not enough to ones that didn't, or that's just the way people are. Well, we developed this show a long, long time ago, 20, 30 years ago, to answer your financial questions. We try to do it without giving you all the Greek alphabet, telling you what the alphas, betas, and gammas, and all those kind of things, even though I know what they are.
Forward yield.
Oh yeah, there's all kinds of different things that wholesalers try to impress brokers. You say that to clients too much, their eyes glaze over. And the ones that do love that kind of stuff, what's your standard deviation, blah, 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 are doing it themselves anyway, and they think they know more than you anyway. So that's kind of the way. So we're going to do the questions this week. Remember, if you have any financial questions, don't hesitate to call us at 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. All right, Guy, what's the first question?
First question is, well, looky there, it's timely. The market is getting pretty volatile right now. Are there any strategies that might work in this market? You think a butterfly spread?
Yeah. Those are option strategies, a butterfly spread.
Playing both sides of the, whether it goes up or down. You only lose your premium. I'm sorry, go ahead.
There's every kind of spread. We used to be back, 25 years ago?
Yeah.
We were option traders way back in the day. And so you did a lot of different kind of option spreads. Right now, by the way, you can't. I do an option spreads right now like the S&P would be suicidal. Don't do it.
Oh yeah,
they cost too
hammered.
much.
Oh yeah,
don't do it. Yeah. I know some people think they're good enough. They'll do like a S&P mini, whatever it is. It can't work out for you. It's very likely
volatility make them expensive. You'd have to really make it to make some money, wouldn't you?
Yeah. What happens is you can always hedge a portfolio. Like let's say I've got the S&P 5, I bought the Vanguard 500, and I buy S&P 500, puts or whatever in case it goes down. They offset the loss.
Like a strangle or something, both sides of it.
Right. The dang thing's too expensive now, though. Those options are too expensive. So when you're buying those options, the hedge or the insurance against loss costs too much. If it was much cheaper, you could make it. Remember, you only made 5% for the last 18 years in the stock market. Look it up. It's there, right? 5%. If your hedge is costing you 8%, that's not a good deal.
That's right.
If it costs you 1%, maybe, right? There's always a cost of a hedge. I prefer, either have a income strategy in place so you don't have to sell the market. Because if you're taking money out of a decreasing market, it's sequence of returns risk. You will go broke. Do not do it. If your market goes down 50% and you take out 5% a year, that was your number. Now it's 5%. You can't. It's a death spiral. You cannot come back. Now, I'll show you the math if you ever want to.
Now, what we're saying is not to stop withdrawing from your accounts, but what we're saying is have an income account set up that takes care of your income so you don't have to withdraw from the market.
That's right.
We're not saying don't withdraw until the market steadies out.
You got to. So you need that. If you're okay with keeping that market side where even if it's dropping, you can just hold it. That's okay. I prefer more active strategies right now, like our one at Fidelity. We use a program that basically is in every sector of the market. If any sector were to go down below its moving average, it would be out of that sector. Is it perfect? No, it can't be. It's not perfect.
Do you know what moving average it is?
It depends on the sector.
Got it.
You got 10 sectors in the U.S. stock market. Actually, 9 ETFs will cover the 10 sectors. But like a utility sector would be less volatile, so you'd have a longer moving average.
Got it.
Anything is more volatile. A smaller moving average, shorter moving average because it's less volatile. More volatile, otherwise you get whipsawed in and out.
Yep.
So something that's real volatile like the S&P, you're going to have a broader one. And so that's why some more simplistic programs like 200-day moving average, all that kind of stuff, don't work nearly as well because they can't all fit in that nice little box.
Got it.
Some of them need a 50-day moving average, a 90-day, a 30-day, or...
So it varies based on the sector.
That's right. So that's what you do there. And it's not perfect. I think it lost 7% one time, but that's a hell of a lot better than losing 50 twice, right?
Or the NASDAQ did in 2000.
Right, well, it's like 80 or something.
Oh, it was ugly.
It just took recently, the last few years came back.
Right.
I mean, it took a
long
time.
to come back. That's right.
You know, it took a long time. So I like proactive strategies right now. Don't get me wrong. After the market corrects itself, you can go back into the buy and hold stuff and do pretty well, I think. But I think I'd like protecting the money because I'm not a gambler. Once I get the money to a certain level, now I'm aware that if this is my market money, the market's what got it to that level. But I also am aware that every time the Shiller PE ratio gets to 30, you've never had a time made more than 2.4% for the next 15 years, ever. And so, okay, so it makes sense, right? If the higher the valuation, then it shouldn't make as much. If it's lower value, there's value there.
Right.
So therefore, it should make more. That makes sense, but people forget it. All they think about is lately.
What strikes me about the question, I'll jump in real quick, is the second half, the question part of it says, are there any strategies that might work in this market? It indicates to me that they perhaps have a strategy, but they're thinking of changing it because the market's changed. You know, whether you're wanting to specifically take advantage of the volatility or if you just want to change your strategy. And again, I would reiterate or emphasize that if you have a good, solid plan that's been stress tested, which we certainly can do for you, be happy to do it for you, you're good to go. Everything should be fine. You should have your liquidity. You should have your income. You should have your market money. And you shouldn't have to, other than rebalancing and doing some basic things. So the short answer to the question is, yes, there are strategies. The other part of that is you should already have those in place. You shouldn't have to run around and change because of volatility.
And if you got any question on this you'd like to see about the other strategies we have to combat this market, or like an unbiased opinion of what you've got in front of you and how you've managed it or whatever, believe me, we'll be kind. But we're just going to show you, hey, this might be a better way to control this volatility we have now, plus guarantee that you're going to get some income and, you know, whatever you might need. Some people don't need income, so that's a different conversation.
And this may be a good catalyst to get them to make the move,
right,
to have a good plan.
So our number 972-715-2424, or go to ilovemyretirement.com. All right, what's the next question?
All right, looks like a Social Security question.
Uh-oh.
I read somewhere that Social Security will go broke in 2034. And that is when I will get my benefits. Uh-oh, that can't be good. Does that mean I won't get benefits? And if so, what can I do?
All right. You can get your own, you know, you can do your own pension through an annuity or something like that. Everybody knows that. But let me be honest with the answer on the Social Security. The 2034 figure is when it won't be able to pay if the current trajectory.
Right.
The trajectory is a couple things. Payments increasing a certain amount. The amount of workers being born and coming into the workforce.
And paying into it.
And the people being paid out.
Right.
It's actually gone, the Social Security Trust Fund has gone up the last couple of years. It didn't go to the other way because it makes interest, right? There's billions of dollars making interest and billions coming in every year. It turned to like 2019. Somewhere in 2019 it should turn. But that's, when you get to 2034, it cannot pay full benefits. And so if they don't do anything, it will still be enough to pay about 79% of benefits. So if nothing happens at all, which it's extremely unlikely, I'll just let you know.
Yeah.
You still would only lose 20% of your benefits. So not counting on Social Security, I don't think is reasonable. You will get some Social Security. But think about all they'll have to do. Congress allocates a couple $100 billion, which seems like a drop in the bucket to those guys, right? 100, whatever the number is.
The way they spend money, that's right.
All they got to allocate is that 20% shortfall out of somewhere else, or extend Social Security. You know, like you can't like right now, full is 67, I think, for newer people. Make it 68, 69, or whatever, and or increase from 6.2 to maybe 6.8.
Yeah, and our job is to kind of sell our clients down and our folks. And I would tell someone, certainly don't freak out about this. If you keep Social Security in perspective, we talked about this on last week's show. Social Security should only really represent about 30% of what your needs are income-wise in retirement. So you should have the other 70% planned, whether it's a self-pension or savings or an annuity or a CD ladder in the old days or different things. So if you got 80%, which Victor says 79% would be available in 2034, on something that only represented 30% of your needs, then it's not comfortable, but it's not devastating.
One thing I hear is a lot of, people get emotional when it comes to Social Security. And I'm no pro-government. Believe me, I think they manage things the worst of anybody. I worked in the military for 6 years, and they manage terribly.
No skin in the game.
But that's besides the point. Remember, it's a really good benefit. If you look at what you put in over your lifetime, what your employer put in, and the amount you're going to get, it ain't bad. Plus, you got disability benefits, all kinds of different things. If you die, if you got kids still in the house, all kinds.
Oh, it's a crazy good benefit.
Yeah, it really is. So all the things about it's our money, they're screwing our money, they stole it all, blah blah. That's really not the case, but they could reduce benefits. We've all known that forever, because remember they started in the 30s.
Yeah.
And the average age was 65. They go, we're going to start this at 65. Most people die at 65 or younger.
I know, that's right. Back then.
Right. So demographics, they're keeping you alive longer than you want to be alive nowadays, right? And so that's happening.
Right.
More people are born, because after that's when the baby boomers started coming, 1946. So the baby boomers hit them after they developed this thing. I think it was 1935.
But then they got all the inflow from that, and then they borrowed from the money in the 60s and 70s. And
it said they never taxed it. Right?
Yeah.
It was too much money not to tax.
That's right. The money was gone.
So don't worry about Social Security. Don't worry. We've got a Social Security optimization program to get the most you can out of that, and you can take advantage of that complimentary program anytime you'd like. Our number 972-715-2424. All right, what's the next question?
And it's easier said than done, but also please try to keep it in perspective. And if you can keep it to 30% of your needs in retirement, that's going to save you a lot of heartache.
You're right. It's just hard for people to do.
Some people, it's their whole thing. My mom, it's her whole income, other than savings and such. Sorry, Mom.
You're going to get it later.
Oh, I know. She's listening. All right. Question number 3. I bought an annuity that should pay my expenses throughout my lifetime. But a friend who is a very financially savvy, someone typed this wrong, who is very financially savvy, said that I shouldn't trust the insurance company. They might go out of business. He's created his own income stream that is independent on anyone else for success. Should I consider this? I guess the question is, should you consider doing something yourself opposed to depending on an annuity company?
Okay. You can always recreate the income stream from an insurance company. You can always recreate it. I have customers right now recreating a 10-year pay. 10-year pays, they're basically buying a bunch of treasuries. And you can stagger out these treasuries, ladder in these treasuries, and achieve the same result. The difference between your friend doing it himself, which is nothing wrong with doing it yourself, and what an insurance company is doing is several things, actually. What an insurance company is doing is they, by law, have to reserve 100% of the funds. They average about 105% reserves. So they've got whatever money they say they need for it, they got a cushion, right? They also will take their actuaries, they pay these actuaries quite a bit of money, to determine how long people might live, right? And it's called the law of large numbers. That's what makes insurance work, the law of large numbers. Because what happens is you're going to guess wrong on some people. They're going to live a long time, and you're going to lose on those, right? But you're going to guess some people will die early, and you're going to lose right on that. So they can take the funds from the ones that died early, give it to the ones that, and they factor a profit in there, and it's worked for hundreds of years, and it will continue to work for 100 years. The problem is, if you do it yourself, what if you're wrong? What if you thought I planned a 20-year lifespan to 85. None of my parents lived past 76, so I know that's a good cushion there. And you live to 86. Well, the problem is you don't have the law of large numbers. It's just you. You can't take from these other people that died early and give it to your account to extend you for another 10 years you might live. And so there's so much regulation on how much they have to reserve, how safe they have to make those reserves, and the law of large numbers, which makes it, if they're wrong, they still pay you. If you're wrong, there's nobody there to pay you. So anything it has to do with, if you want to assure for the rest of your life, don't do it yourself, because it's too much stacked against you. Don't get me wrong, it could work. It could work 8 times out of 10. But as soon as it doesn't, you're done. And so you don't know what your life expectancy, and plus what people do is they always think about their own life expectancy. They don't think about them and their spouse. A married couple has a lot higher odds of living longer than a single person. I don't know if anybody knew that.
2 people.
Once a person reaches like a 65-year-old couple, you got like a 60% chance of one of them gets to 92. So what they're doing is they're looking at their own mortality. Like, okay, both my parents died at 70. Am I going to make a plan? I'm going to retire at 70. I'll live to 73. Well, I'm going to be spending a lot of money for a few years, right? No. So that's the kind of thing you got. You don't realize how much goes into and how much assets you have to have and how many people you have to have in this pot to be able to cover life expectancy if people live a long time, which you might. So you might know, your wife might not have anybody make it to 85. You might not have 85. But in today's world, you got a 50% chance. One is you get to 92, and it could be a lot further. And because what happens, like right now, we're in our 50s, right? In 20 or 30 years when we're 70 or 80, it might be another 110 could be the life expectancy. Well, they have to eat that. You can't because you only allocated enough funds to last you to 85.
That's right.
And you were giving yourself 5-10 years extra. That's why you can't do it. That's why a lot of retirement plans that I see are flawed. These retirement plans are based on the first question: how long do you think you'll live? I don't know. I don't have a Svengali hat on. How am I supposed to?
How much do you think your medical
Then they
expenses?
go, well, here's the average person.
Right.
So they use average. So yes, if you do this plan, and these are big financial companies that do it. If you do this plan and you live the average lifespan, you will be fine. But what if you don't?
That's right.
That's why anything that deals with life, there's a reason why the only person, the only company, the only product that can guarantee anything for life. There's only one, and it's an annuity.
That's the difference between a guaranteed retirement and a non-guaranteed retirement,
but it's the only thing in the world. It's because of all those safeguards in place, all the actuaries, and all the law of large numbers. And they have to have all that in place to be able to safely guarantee something for life. And so that's why I wouldn't do anything. But if you want to just make up a 10-year deal, yeah, you can do that yourself all day long. Not a problem. All right, what's the next quote? Might be time for one more.
All right, I'm going to do the Johnny Carson thing here and hold the letter up to my head before reading the question. And the answer is, get a good attorney. All right, let me see what the question is. I'm getting a divorce. Is there any kind of special planning that needs to be done? It works.
Since I have experience in this particular area, they're get an attorney. But no, there's planning to be done. If you're like this happens to my clients all the time. I mean, it's a part of life, right? And what I do, and this is why, in turn, what I think most people should do, is once the assets have been, split up or whatever, you've got to run retirement plans
via court order.
Yeah.
Oh, I'm sorry.
Based on each individual. The couple no longer exists. That entity no longer exists. So you thought you might have been fine. And everybody has a little apprehension anyway, especially if you get divorced older. When you're divorced younger, I'm telling you, those people don't even think about finance.
You're resilient.
Yeah, like, hell,
bulletproof, that's right.
Well, once you get older, it starts really going. You know the average age, I've read this somewhere, that of women getting divorced was in their 50s or 60s. It used to be really young.
Uh-oh.
So that's a time where you don't have as much time for retirement. If your split wasn't enough, there could be serious issues there.
Yep.
Or the lifestyle's got to go down. So what you'll find is some people are getting, all right, they're going to get the house, they're going to get this. But then I realize that house might stifle their retirement because the payments on it or
if the house
taxes
is paid for and it's a $600,000 house, if you don't have $300,000 cash to give your spouse, you're going to have to sell that house, right?
Boy.
So that you can liquidate.
And sometimes it makes that sense to do that or to keep it, and just give them the whatever out of something else. It just depends. But you really need to plan both of them. Even like my clients, if that happens, now everything is not shared. They have to be completely split up now. Everything is done with separate retirement plans to make sure each of them are going. And if we have to do anything, that's what we got to do. It'll tell us pretty quickly. Well, that's our show, folks. I want to thank everybody for listening. Remember, if you have any financial questions or like to take advantage of our no-cost, no-obligation financial review, our number is 972-715-2424. Again, 972-715-2424. Or you can always go to ilovemyretirement.com. I'm Victor McClure. For Guy Allard, we always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.